Through the course of this video, I'm going to be looking at the 10-year and 3-month bond yields and speaking about why I had predicted a crash for 2022 and why it didn't happen and why I think it's going to happen eventually. And also I'm going to talk about the last 20 years of the bond market and looking at what the grades are. And I kind of utilize ChatGPT with that, and I'll discuss that later. But if you look at the red line, that's the inverted yield curve. So around the 2019 period, it inverted, and then I was expecting it to go up to about 2.76, maybe as high as 3, and that would indicate the bottom of the market based off past trends. And the red line, you see it got to about 2, and then it started to go down. Why did it go down? And I notice when you look at the green line, that's the 3-month bond yield. The Fed, all of a sudden, it was around 2021, they increased the 3-month bond yield, which caused the red line to invert again because the spread between the 3-month and the 10-year started to decrease rapidly. And you see where the green line meets the blue line, that's when it inverts with the red line. And it was that was done by the Fed. And it was done to cool inflation, but what they ended up doing was prevented the market from, in my opinion, reaching that 2.76 to 3 range and getting to the bottom of the market. So that didn't happen, and the inverted yield curve in red goes back down and does a second inversion without a stock market crash. So the Fed's looking at lowering interest rates eventually. So that green line is expected to go down. But I do want to speak about the bond market and its ratings. Working with ChatGPT, I looked at what the ideal spread is for the 10-year and the 3-month. The 10-year is supposed to be greater than the 3-month. It's a sign of a healthy market. Ideally, if the 10-year is 2.5% greater than the 3-month, that's considered good. So we'll give that 4 points. And then if it's between 1.5 and 2.5, 3 points. Between 0.5 and 1.5, 2 points. And between 0 and 0.5, 1 points. And if it's a negative spread, which would be an inverted yield curve, that would be 0. So we're also going to look at the 3-month because when you have a low 3-month, if it's like close to 0, it's seen as like an unhealthy sign because the usually the Fed's pushing down the 3-month, the short-term rates in order to boost the economy due to recessions and things like that. So that's an important factor to take into account. So here, if it's between 3 and 6% for the 3-month, it's 4 points. But if the spread is 0 and it's in an inverted yield curve, that would mean that it would only give 2 points. And then you can see between 1.5 and 3%, it gives 3 points. But if you have a negative spread, then 1 point. So it's important to note when that 3-month is really low. And then you can see where it gives 2 points and 1 point, and then 0 points. So if you add up all the points together, 7 to 8 would give an A, 5 to 6 would give a B, 3 to 4 would give a C, 1 to 2 would give a D, and 0 would give an F score for the bond market. Between 7 and 8 is A. In the last 20 years, we didn't have anything that would be considered grade A bond market. But between 5 and 6 would be grade B. Around the 2005 period, we had a grade B, but it went down quite a bit. Like in 2008, you can see it went to 2. So we had a grade D in 2008. And then in 2010, that's a 5. So that would be like a grade of 5. I mean, a grade of B. But right now, we're currently at a grade D at 2. Is considered a bad, an unhealthy bond market for the economy. We'll go to the spreadsheet that's driving the chart that you just saw. So in 2023 and 2024, and also in 2007, the bond market gets a grade of D. and that's based off of having a low spread. You can see in all three areas that have a D, you can see that they have a negative spread. So if you look at the spread in yellow, it's got negative 0.29, negative 0.96, and negative 111. So a negative spread's considered a bad thing, which is causing the grading of the spread to be 0, and you can see that in yellow as well under the G column. And then also you have the grading the 3-month, so you can see where it's in yellow. The 3-month yield in the E column is very low, which was causing that area to have a grade of C. So I do have the formulas that are driving the grading of the spread and grading of the 3-month. So grading of the spread, if F2 is greater than 2.5, which is F2 is the spread, then it gets a 4. So you can see it gets a 4 for the first one because the spread of 3.27 is greater than 2.5. And then also if it's greater than 1.5, then it gets a grade of 3. So a grade of 4 would basically be an A for the grading of the spread. And here's the formula that's showing the grading of the 3-month. I had a little bit of help from the AI on this formula, but it does help to grade where it's at based on the rules that were shown previously. Here were the rules for grading the 3-month, so that was inputted into that column. That's all I got for now. Just wanted to give an update on my thoughts on the bond market. And right now we're in the D grading as far as what's been discussed here. So it's looking like a challenging market, and it looks like the Fed's going to have to drop interest rates to kind of prop up the market a little bit more. So just going to have to keep monitoring it. But it's not considered a healthy bond market at the moment. So I wanted to pass that along.